As Africa's capital markets continue to evolve and expand, investment managers will have the opportunity to construct ever more specialized portfolios. Investec Asset Management recently launched an African Credit Opportunities Fund to complement its existing African suite of funds. Portfolio manager Steven Loubser joins us in Cape Town to discuss what the funding plans are in terms of the fund. And of course, Warren, before we go to Steven, let's just get your scenario setting.
Yes, that's right, Bronwyn. We just obviously wanted to frame the context of the discussion with Steven a little bit better this evening. And I've just got a few graphs just to talk about what's been happening now as Investec moves into a fixed interest portfolio. There's a couple of things they need to think about when they manage the portfolio, and one of them is equities. No, it's actually Forex. But just to give you an idea here of how African equities have performed over the last it's about the last 12 years. You can see the run-up of the emerging markets index in red, the MSCI Africa index in red against some of the emerging markets. And you can see after a steep fall, they haven't quite recovered, but last year was a fairly good year. We saw some of the African indices returning about 40%. If we just go to the next slide, which is more applicable to what we're going to be talking about today with Steven, is how to manage the Forex risk across different African currencies. And here you can see the African 10, and it's basically a basket of 10 African currencies, and you can see how it's performed relative to the US dollar in the black line and the euro in the red line. So it's come off a little bit in the last 4 years. You can still see it's almost about even, but still below the 100 index threshold. And then this is something that's really interesting from an offshore investor's perspective, is what we call the carry trade. And the next slide will show us just some of the money, how the guys are making money, taking the very low interest rate environment in the developed markets and then investing those into higher yielding instruments on the African continent. But there's obviously the plus and the minus. What you can make on the swings, you can lose on the roundabouts, because if we look here, this is over a 4-month period. You can see in the light gray some of the gains that they've made in the Forex market. Sorry, the light gray is the returns they've made investing in fixed interest, which is this top line along here. And then you can see with regards to some of the countries like Malawi saw the big currency depreciation. You can lose a lot of value there. So that's just against, this particular one is against the US dollar. The next slide's against the euro, and that's obviously the two primary geographies that investment managers are borrowing money from to go and invest offshore. So I think that frames it, Bronwyn. So we're going to be interested in hearing from Steven exactly what they're going to be investing in the African Opportunities Fund.
Well, Steven, I know you've been doing a lot of on-the-ground research, given the last time I saw you was in Tunis, in Tunisia, at an African Development Bank conference. So where do we go in terms of the rationale for the Africa Credit Opportunities Fund? Perhaps just start there.
Thanks, Bronwyn. I think it's good to give a bit of introduction and set the scene. Warren's done a fantastic job in discussing the various asset classes. But really, if we take it back to the basics and the starting point, South African institutional investors have a 5% allowance to invest into Africa. So for the last 10 years, South African investors have had an absolutely fantastic ride. Equities have done brilliantly, South African bonds have done brilliantly, and South African properties done brilliantly. But it's starting to feel as though we're at the top of those various markets, and South African investors are saying, what about that 5% allowance into Africa? And they, like the rest of the world, is hearing this fantastic story about investing into Africa. But the question is where and how. Warren's shown you the graph of African equities, and last year African equities did close to 50% in Rand, and I think this year they're probably up 10-15% in Rand. And that's a fantastic swing in 1 year. But if you look at the back of that graph from the peaks in 2007, I think they dropped 50 or 60% in a year as well. And that type of hairy ride, I'm not too sure everyone is keen on. And that's where we really came up with the idea of putting an Investec Africa Credit Opportunities Fund together.
Just to get to, Steven, to throw a couple of numbers in there again, just in terms of context for the audience. You're looking to raise $350 million, and you've got $60 million already in the bag from two funders. Is that correct? Two anchor funders.
That's absolutely correct. Yes, so the two anchor funders are CDC, it's the British Development Agency, and FMO, the Dutch Development Agency, and they've come in as early investors. But we've really tried and tested the investment strategy over the last 2.5 years. So we've invested over $150 million in African equity in our other funds. So back to where I was to say African credit really gives investors exposure to a different side, lower risk opportunity in Africa. So we put together a portfolio of high yielding credit opportunities, and the aim is to try and give equity-like returns, but removing some of that volatility. And I can describe the strategy a bit further as we go into it.
Stephen, I think just for the purposes of our audience, and obviously we're very familiar on the show with some of the challenges that the equity managers face in investing in Africa with regards to, first of all, the universe, and second of all, liquidity constraints. Just tell us exactly what type of debt instruments you're going to be investing in this fund.
Sure. So really, when we call it an opportunities fund, the idea is to be very opportunistic. When building a portfolio in Africa, there are enough limitations and you don't want to have a limited mandate. So we'll be investing in the likes of high quality loans originated by banks to African companies. We'll also be investing in bonds and convertible bonds. And from time to time, we'll find derivative exposure in the likes of CLNs. And there are other special situations where we would find promissory notes or structured notes. So it's a very open, broad mandate, which gives us our exposure.
Just to go into that a little bit more, Stephen, in terms of the, we talked off air this morning around what exactly the fund invests in. You were telling me there's not going to be any government debt in this portfolio. It's going to be very focused on private sector debt. In fact, you don't expect to invest much in state-owned enterprises either. So just in terms of that set, what are the sorts of companies that you're seeing and what sort of sectors are they operating in on the continent?
And then further to that,
Sure.
let's throw in the geographies as well.
Okay, absolutely. Well, maybe I can just touch on it. One of the limitations that our colleagues in the equity world experience in Africa is that not everything is listed. So there's actually a very small percentage of entities or companies listed in Africa, and that's the beauty of credit. We can provide debt to big listed African companies. So that's part of the strategy, is to target the listed market dominant companies. And then we can also play in the unlisted space. And the unlisted space is very broad. It can range from infrastructure projects, it can be property projects, and the full range. So
do you have
the
a
listed
split?
side and the unlisted side.
Do you have a set split between the listed and the unlisted space that's already defined?
No, not really. As I said, we're very opportunistic and it's bottom up. It really depends on what's coming along. So I would say, give or take, let's call it 50-50 at this point as a starting point, but we'll see how the market develops. I think if we look at our current portfolio, it would probably be biased. It would probably be 50-50 in terms of giving credit to listed entities and unlisted entities. So really, we're doubling the universe in the credit space by being able to play in listed and unlisted. So that gives you a first sense. And some of the exciting stories that I discussed with Warren this morning was really around themes or sectors. So the first one, and the one that we love most, is the African consumer. That's the story that will prevail throughout. And that could be FMCG businesses, brewers. We would almost put telecoms into that on the consumption side. The other sector would be property or real estate. And we're starting to see the real pioneers go into Africa and doing very good things in the property space. So that's a theme we would be backing. The next big ones would be financial services, so banks or other non-banks. And what we've always found through our experience is banks don't give other banks money, or they don't give their competitors money, both for competitive reasons and for risk reasons. And as institutional investors, we've always found fantastic investment opportunities in providing African banks or financial institutions with capital. And then the big story, and the story that everyone gets so excited about, is resources in Africa. And we feel Africa is way more than resources, but that's always the tailwind that is there that's sort of helping the markets develop. So we are seeing massive companies, anywhere from $2 billion in enterprise value up to $10 billion in Africa, that need debt capital, and we're providing them with debt capital.
I know Warren's wanting to jump in. Warren's wanting to jump in, but I want a little more clarity on those geographies.
Geographies. Okay, so back to geographies. Warren and I discussed it this morning. They're obviously the 4 pillars in Africa: north, south, east, west. So on the western side, we've got Ghana and Nigeria, and those are the exciting stories, the rising stars. And a good 30-40% of the portfolio will probably come out of West Africa. And then we would look at sort of the smaller countries on the west side. On the eastern side, you have Kenya as the main powerhouse and some of the exciting markets that form part of the East African community. So Tanzania, Uganda, and Rwanda, we'd see a good portion there. And then on the southern side, obviously South Africa is the main driving force. In this portfolio, South Africa is not a focus. We've got other strategies that are focusing on South Africa. But we'd say the periphery countries in SADC, Zambia has been a great destination, and we've got a few good portfolio investments in Zambia. And then Zimbabwe, being starved of capital, we're able to also find special situations where we can invest in Zimbabwe, where we get guarantees and where we're able to get rid of some of the country risk. So I'd say those are the pillars and the cornerstones. North Africa has been very difficult at this stage, and I mean your big forces in North Africa would be Morocco and Egypt. And we're probably going to go in and start building a North Africa pipeline, because we're starting to sense that those countries will get through their political issues in the coming years.
Stephen, just to talk a little bit about the capital requirements of some of the businesses in Africa. We've seen some fantastic business models opening up across the continent. Some of them are from South African banks, but a lot of them are from local banks that have started to build a real presence on the continent. Just what is the difference between your fund and a multinational finance institution like some of your funders, as I understand it, are classified as? Where do you sort of draw the line between what a global bank would be doing, lending to some of these other financial institutions, and being a credit fund like you are at the moment?
Yeah, that's a very good question. And I would say the key difference is we're way more opportunistic. And our main aim is risk-adjusted returns. So we're looking for the highest yields with the lowest risk. And we're a lot more nimble, we're faster moving, and we're able to play both in the loan space and the listed bond tradable space. So a typical bank, let's say our big 4 South African banks that are doing a fantastic job in Africa now, they don't get involved in the listed tradable bond space, and we see great opportunities there. So they won't buy something low, sell it high, and lock in those capital gains. They're very much about lending, extending balance sheet, and they're also far more concerned about getting some of the periphery business, such as the forex or the trading lines. So, and we're not too concerned about those pieces of business. We just want to buy a very good business or extend credit, put it into a portfolio, and get the best risk-adjusted returns. So
I want to focus.
Differences would be.
All right, sorry. Finish with that, and we're running out of time, so I tend to jump the gun. Just finish with that thought, and then I've got one more question for you.
Yeah. So the difference is we're more opportunistic, and we're more concerned about absolute return versus risk.
Just on that unlisted space, that's got to take a hell of a lot of work on the ground, and I know you travel extensively to really pull out the gems in the unlisted space. How are you going about that process?
Yeah, Bronwyn, it's absolutely true. Africa's a great opportunity, but it is hard work finding it and uncovering, really finding the jewels in the dust or the gems in the dust. And fortunately, I've got some colleagues in the equity space, the private equity space, and ourselves as a firm that has been there and been laying those railway lines a lot longer than we have. So we're leveraging off a team that's probably 30 people in size. So we're really using the full team to originate opportunities and understand the companies and the situations and the opportunities. So we're really riding off on the tail skirts of some of our colleagues. And then we're adding that on-the-ground due diligence ourselves. So I think in the last 5 years, we've probably done 200 or 300 company or country visits as a team, and we've probably seen companies over 1,000 times in that time. So there's a big institutional asset there of knowledge.
Stephen, just an important question, and one I wanted to make sure we had asked you before we go, is around the managing of the forex risk. You mentioned your strategy this morning today. I wanted to just say, ask you for the benefit of our audience, what is your policy or your approach with regards to managing the various currencies that you might be investing in?
Yeah, Warren, going back to your first question, what we're trying to give investors is a taste of Africa, but taking out some of the bigger risks, and currency risk is the big one. So we're doing all of our lending in US dollars. We're getting a spread over LIBOR, and we've been able to isolate that. So really, it's a dollar strategy. So some of the investors are going into Africa for the first time. We don't want to add currency or FX risk to that. So this is a dollar proposition.